the date? Friday, December 12th, 2025. For most Americans, it will look like any other day. Streets will fill with commuters, coffee in hand, and the stock market will ring its opening bell, signaling the start of another day of trading. News anchors will fill screens with election updates, celebrity stories, or the latest winter storm sweeping across the Midwest. Everything seems normal, but behind this ordinary day lies a moment that few will notice, a decision that could reshape the next year of the U.S. economy. Deep inside the polished corridors of the Federal Reserve Bank of New York, a small group of unelected officials will gather in quiet secrecy. In a restricted meeting room, they will discuss a decision so powerful that it will ripple through the entire financial system. No headlines, no public announcements, just the subtle click of a decision being made. And then a switch will be flipped. Why? On that day, the United States Central Bank will quietly restart a process it hasn't used in years, the creation of new money. Not loudly, not with dramatic fanfare like 2008 or 2020. Instead, it'll be buried under technical language so dense that even those reading the announcement 3 times might not grasp its significance. They call it Reserve Management Purchases, RMP. It sounds mundane, a minor accounting adjustment. But in reality, it is anything but ordinary. This is stimulus, and it is powerful. Starting December 12th, the Fed will inject $40 billion every month into the financial system. At a time when the stock market flirts with all-time highs, inflation is stubbornly above target, and the federal government borrows at record levels, this is not a small adjustment. It is gasoline on a fire. RMP will act like a hidden hose of liquidity, quietly flowing into banks, then into investment markets, and eventually into asset prices. Historically, whenever new money floods the system at the peak of an economic cycle, the result is predictable: a market melt-up. Asset prices surge, seemingly out of control, just before the inevitable correction. And this is what the Fed is aiming for: a controlled, behind-the-scenes surge that will encourage investment flows into stocks, corporate bonds, and other riskier assets. But the story really begins 2 days earlier, on December 10th, when the Federal Reserve concluded its latest FOMC meeting. The headline was simple: a quarter-point cut in interest rates. But this was no celebratory cut. 3 officials dissented, arguing rates should remain where they were. Inflation, particularly supercore measures, is still running hotter than the Fed would like. With nearly $2 trillion borrowed yearly, cutting rates is risky. It could ignite the very fire they're trying to control. The market expected 4 or 5 rate cuts in 2026, yet the Fed projected only 1. Typically, this would trigger panic, but instead, markets rallied. Why? Because the Fed unveiled a new strategy. Even if interest rates remain high, liquidity will rise. This pivot shifts focus from price control to liquidity control. In modern markets, liquidity is king. When it flows, asset prices follow. And the Fed's RMP is designed to ensure that liquidity flows even if rates remain elevated. The urgency of December 12th can be traced back to September 2019, when the repo market nearly broke the financial system. Overnight, lending rates spiked, banks froze, and liquidity vanished. The Fed had to inject billions to stabilize the system. Fast forward to 2025, the balance sheet has been shrinking, reserves have dried up, and the reverse repo facility is empty. Warning lights are flashing again. December 12th is not optional, it is necessary. Understanding RMP also requires understanding the U.S. debt situation. National debt exceeds $37 trillion, growing by $1 trillion every 100 days. Interest costs surpass defense spending. Foreign buyers of treasuries are pulling back. The Federal Reserve is stepping in. RMP is not just liquidity, it is a silent bailout of the U.S. Treasury. Fiscal dominance dictates that the central bank must act, even if inflation rises. What happens next is predictable. When the Fed injects $40 billion monthly, investors holding T-bills are cashed out and must redeploy their funds. Safe yields fall, and money moves into stocks and corporate bonds. Indexes rise. Fear of missing out spreads. A melt-up forms. Launching this just before the seasonal Santa rally supercharges the effect. Analysts expect major resistance levels to be broken in early 2026. The Fed put is back.